Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
All right, guys, today we're going to dive into the topic of investor protection, focusing on the safeguards that exist on the assets that are in bank accounts, brokerage accounts, and when your brokerage account is invested in certain securities. And I think this has come sort of full circle. And the reason that we're talking about this is because of the failure of Silicon Valley Bank last week with the FDIC taking control of it. There's other specialty banks that seem to be having problems. Investors are taking their money out of regional banks and some of these community banks and moving it to bigger banking institutions. And then we also have this thing that we'll get into maybe at the end with the government backstopping deposits. But we just thought this, it's an important topic. It's on a lot of people's minds right now. And so we wanted to sort of dive into some of these protections that investors have. But to start, I think, let's just talk about the different types of accounts that someone can have. Someone could have a bank account, someone can have cash in a brokerage account, or they can have their brokerage invested in certain liquid securities. So let's go through each of those, Matt and Jack, and talk about the protections that exist in each of those cases, and what type of insurance that people have. So to start, let's talk about the cash held in your normal bank account, your checking account, your savings account, and the protections there.
And let's also first say, it's bad. I know it's bad when, of the client conversations and the other things I'm having during the day, I'm getting the text from my grandmother over the weekend saying is everything okay? Do I need to pull my money out of my bank account? So asking what these protections are or understanding them is really, really important right now in the wake of all this craziness that we're seeing on TV and all around us. So just on, let's say what the different things are first. So beyond banks, but let's start with banks and then go beyond banks. Banks have the Federal Deposit Insurance Corporation, or FDIC. And we'll give numbers and how all this works in a minute. But basically your bank is protected by the FDIC, and that is insuring depositors at deposit institutions like banks. If you have a brokerage or an investment account of some form, that falls under SIPC, the Securities Investors Protection Corporation. If you have life insurance or an annuity, some insurance product with cash value, that falls under different state guarantee programs, and that's your government backstop there. And finally, in credit unions, you have the NCUA, the National Credit Union Association, I believe. And if you have money there, that's your backstop. So we have these entities. They all have government protections behind them.
So let's start with banks then. What is the level that an individual's bank account is insured up to through the FDIC?
So technically, you have $250,000 per, and this is where it gets a little confusing, but really important. You have $250,000 per depositor, per institution, and then per ownership category. And this gets into the weeds, but if you have less than $250,000, stop right there. Don't really worry, as long as you know you have FDIC insurance. If you have more than $250,000, especially per deposit institution, then you have to go further and look at the ownership categories and understand what the mix is.
And with brokerage accounts, it's a different type of insurance. It's called SIPC. So what are the levels on that?
So SIPC, generically speaking, same things apply. You want to think per account holder and per institution. But really what you're thinking there is $500,000 worth of insurance. But notably, this works in a very different way. And that is, if a bank fails, that first $250,000 is considered your insured deposit. If a brokerage fails, SIPC steps in and basically says they're not guaranteeing the value of your account, but they're giving you the quantity of what you own. So the 100 shares of Apple may or may not be worth more or less than your brokerage when it failed, but SIPC's there to try to make sure you get your 100 shares of Apple back, no matter what the value is.
Specifically speaking to brokerage accounts here, and the cash in the brokerage accounts. And then what about, well, I guess if you have your money at a brokerage and you're invested in, let's say, I don't know, whether it's Apple or even ETFs that are highly liquid bond-like ETFs, if a brokerage were to fail, then those assets basically are on record at the DTC. And so it's not like that money, you lose that money because that's in publicly traded holdings.
So it's really important when we talk about SIPC and the protection of your brokerage assets is to remember that this has come a really long way. And even when we talk about the collapse of Lehman Brothers, or we talk about the Madoff scandal, if you have proof of stuff that you held in your account, especially publicly traded securities, you're probably going to get those back in full, regardless of the dollar amount. Again, not the value of them, because that can change. They're not guaranteeing that, but SIPC's there for it. SIPC, do you guys know where SIPC came from? Do you know the origin story of that wonderful government entity? So SIPC, kind of interestingly, comes out of the late 60s, early 70s, when trading volumes spike. And so you have all these people opening trading accounts, retail accounts, business accounts, and this activity literally spurs a paperwork crisis. So as nuts as this sounds, you'd place your order for your stock or commodity or whatever you're doing, and then paperwork has to change hands to settle the transaction. There was so much paperwork in the system that brokerages started to fail. And as those brokerages failed, people would be like, well, it says I bought this security. And then my failed brokerage would be like, we haven't batched the paperwork yet. We don't know. So SIPC was created to make sure those records were being held and accounted for, and you didn't get ripped off if somebody just, lost your document. Now in the modern era of how we can keep track, especially of publicly traded securities with our custodians or wherever we hold our assets, Madoff, Lehman, you can look at the most recent examples on the SIPC website. If you had a share of something, even in excess of those dollar amounts, your share was protected for wherever it ended up next.
Just as a side note here, I don't want us to go too far off track, but what is interesting is you have I'm thinking of all these other places that have emerged, like Coinbase. You have these other exchanges, if you will. And on those exchanges, you can certainly have cash. And this type of insurance that we're talking about, and this leads into my next question. It's where can people go to tell if their money is insured by a specific entity? I think, I was just thinking in my own mind, there's a lot of other places that kind of people have money now that you kind of got to look at the fine print to say, okay, wait a minute. Does this place have any government type insurance? So, a lot of the times that's in the fine print. You got to dig around to find if the institution is insured, or I don't know, Matt, is there a central place that you can go to look to find that?
So usually the best place to look and think about where it makes more sense for you and not. If you have millions of dollars in a Coinbase or something like that, you care more than if you have $5 in your Starbucks app, probably. But for all of these, any place that you're putting cash into or investing money into, go to their website and search in the website for FDIC and SIPC. And if they're a bank and offering banking services, you want to know if you have insured deposits or not, or if you're above the insurance amount. And same thing for SIPC, because they have to self-report and tell you they are. And if you can't, either ask them the question or ask a professional the question to vet what's there.
I want to dig in a little bit to the thing you mentioned in the beginning about the details behind the FDIC coverage. I remember this is a question I hated on the CFP exam. It would be something along the lines of, Bob has 4 accounts at ABC Bank. He has $250,000 individual account. He has $500,000 with his wife Nancy in a joint account. he has, a trust where there's 3 partners in the trust, and, the total account has 750,000. And then he also has his retirement account. It would be like, how much FDIC insurance does Bob have? So can you maybe answer Bob and talk about how that works on an account by account basis?
Yes. And for anybody, again, once you're over like the $250,000 in a institution, you should be having a conversation about this with someone, a CFP or a financial professional or otherwise, just so you understand what risks, if any, you're taking with this money. So I want to go back to what I said earlier, that you have the depositor, you have the institution where you're holding the money, the bank in this case, and then you have the ownership classification. And so $250,000 per individual, per institution, per ownership classification. So let's use a little bit of your example. Let's say, Jack, that you've got $250,000 in your personal name account. Your spouse is $250,000 in her account, and then you have $250,000 in a joint account. So personal accounts, joint account, 2 different ownership classifications. So what's cool about this is you've got your 250, your wife has her 250, and together you have a joint 250. So right there, we're already up to 750. Heck, you could even put 500 in that joint account because you're both covered on it. I mean, get you up to $1 million in FDIC insured. So despite having more than $250,000 at one deposit institution, we are able to extend that insurance just by titling because of that ownership classification piece. Now, where this gets in the weeds, and what I would caution people to understand, is as soon as you start to extend or add on other ownership classifications, if you have trusts, if you have transfer on death or payable on death beneficiaries, if you're equally putting these people on, so you have 2 kids maybe, and they're each 50-50 as TOD beneficiaries on the account, that's going to extend your FDIC insurance. But the minute you start slicing and dicing where one kid gets 75%, the other gets 25%, or a trust, which has multiple beneficial owners with different ownership stakes, this stuff does get complicated. And if you're into that situation with more advanced ownership classification types, you'll want somebody to help build this table out. I'll give a massive shout out, and we can share it in the notes. The FDIC has some great resources on this. So they have a brochure that's current that we can share and actually walks through a bunch of these examples, probably straight where the CFP exam pulls them off of. And they're really informative, and they will probably, for most people, highlight why you want to work through this with a professional too.
Now I just have to find out how to make your example a reality and come up with $1 million to put in my various checking accounts. So I can see this in the real world. I want to ask you about what happens when the FDIC takes over a bank. It was actually, we sort of saw this in real time last weekend with Silicon Valley Bank, but from the perspective of a depositor, like what happens in your life when the FDIC takes over a bank where you have deposits?
So I think this is a really important aspect of this, and having lived through the Lehman situation and watching that with a front row seat go down and some of the other stuff we've seen in our professional careers here. It's what happens on the news and what happens in the movies that we'll create after the news aren't always the boring reality of how this works. So technically, the FDIC doesn't want to take over your institution. And that's a good thing. The first thing they want to do is facilitate a transaction to another bank. So what they would have loved to see happen is, if there wasn't this whole like bank run and chaos situation over the last weekend, they would have said, hey, somebody else come in, acquire this bank. And the idea being, those bank customers still need to be banked somewhere. Those deposits still need somewhere to live and somebody to service this stuff. Even if this bank is going out of business, we want those depositors to be able to go out and make payroll checks into the system and all those important things. So they avoid trying to take over if at all possible. Now, in a case where they have to step in and take over, which is what we saw, the first thing they do is they say your insured deposits, which we just went over in that last question, those are all pretty much going to be available right away. And if they can facilitate you being able to still use the account, great. If not, they can cut you a check or send you something to the institution of your choice where you're moving your accounts to. Above the insured amount, so your uninsured deposit, then the FDIC goes to work and has to work things out. This is the part where it gets a little sticky. This was one of the big questions going into the weekend, was what would happen with all those uninsured deposits. Those get paid from the FDIC as a dividend and sometimes can take a serious amount of time for those to get paid out. The good news is on those insured deposits, you get your money back, usually relatively quickly, if not immediately. I can say with firsthand experience with a client during the financial crisis who had under the federally insured amount. So they were fully insured on some Lehman Brothers CDs and a corporate account. And those pretty much got settled out right away. And it was an amazing, like, oh, the system works. We had a catastrophe, but it didn't break. And we've learned a lot in the financial system and regulatory system since that financial crisis. And we saw the benefits of that in real time over this weekend.
I mean, it was amazing to me how efficient they were. I mean, they came in Friday, they closed the bank. By Monday, it was open. They had a new CEO in there. Like, I mean, they mean business. I mean, they come in here and they get the job done.
They mean business. And it's also important to say, like, we don't want banks and we don't want the FDIC to be the DMV, right? Like, we want this to not suck. We want businesses to exist and thrive in this space. And to an extent, we need the backstop that keeps depositors safe. But yeah, what they did this weekend was brilliant in terms of government work.
Yeah, Matt, one question is, since the financial crisis, isn't there like, I'm thinking of like maybe some of these brokers that are actually doing things differently where there's a blend of SIPC and FDIC insurance that, your average investor might not know unless they look into the fine print, but it is there.
This is why I said you have to go to the website of wherever you're doing your business. As a financial professional, or as a consumer of this stuff, because different places are different. In the financial crisis, you might remember, like, everybody wanted to become a bank all of a sudden. So as these entities were failing and the banks were getting these big, these backstops and bailouts, you had like Goldman all of a sudden racing to become a bank. So what that leads to is that sometimes inside of just your brokerage account, you might find you have a bank insured sweep program. And you might have a combination of SIPC and FDIC just through your brokerage account by the nature that your broker dealer might also be a bank. Above and beyond, many modern, and we should just mention what SIFIs and GSIBs are in a second here too. Many of your modern financial institutions, because they're a blend of these two things, are also able to offer additional protections. So if you are a business, like think of some of these venture companies, and who knows why they were doing what they were doing, but this was the choice they consciously or unconsciously made, is you have things like insured savings accounts. So many major broker dealers and custodians will offer, once you go over $250,000, we have a network of partner banks. And in many cases, you can see from a few $1 million up to multiple teens or 20s or hundreds of millions of dollars potentially that you could still have FDIC insurance of inside of special vehicles. So when I think go to the website to look, you want to know what the firm you're dealing with is offering, and you'd probably be surprised for people with greater balances what can be accomplished in these vehicles now because of the financial crisis.
From a practical standpoint, how do you advise clients with respect to this? So if I had millions of dollars, which obviously I don't, to be putting in like a bank account, on one hand, you'd say, all right, I want to spread this. Yeah, I want to follow the rules you gave us before, and I want to make sure everything is insured. But from a practical standpoint, that's a lot of work, and you got a lot of accounts going on there. So how do people think about this in the real world?
In the real world, you think about what risks are you comfortable or are worth taking inside of an institution. And for most people, like if you've got hundreds of millions of dollars and you need to sit in cash, and I'll use the example because that might seem outlandish to a lot of people, but this is the case with lots of like institutions, endowments, like family offices. This is just part of the reality. And so you can do things like you can own treasury bonds. You can use insured savings accounts. You can use money markets, and understanding the different classifications of money markets so you know what the underlying securities are in that stuff. There's a solution, but that solution is going to be based on not just your risk tolerance, but sort of like your regulatory risk tolerance for this stuff, and going, some people are more scared of bank collapses for one reason or another. And they're probably going to have, in the multi-million-dollar case, they're probably going to have 3 or 5 or 10 different bank relationships. Others are going to go, well, I'm not so concerned about that, but let me be as smart in my one institution as possible. And I started to mention it, but let me just bring it up. So you have your GSIBs and your SIFIs, and this is all stuff that more or less came out of the financial crisis. So you have your global systemically important banks, that's your GSIBs. And then you also have your SIFIs, your systemically, I'm butchering the acronym, systemically important banks. Hopefully you can edit that. Financial institutions. Thank you. Systemically important financial institutions is your SIFIs. So you can go on to both of these things. They have websites, or just Google it and you can see who the lists are. And when you look it up, what you'll see is like, this is how high or low in the pecking order different things are. And you'll find out that like the JP Morgan and stuff are like really close to the top as being the most important and arguably the safest institutions for depositors, not talking about investments. Just like as a depositor, these are your safest entities. And as you move down the list, you find out which ones may or may not, wreck the whole system if something goes wrong. And those dividing lines are real, and the regulations change as you move across those lines and get all the way down to the local podunk regional bank and how systemically important they are.
Yeah, that's practically important as well, because from the perspective of, obviously they just showed with Silicon Valley Bank that the government will backstop deposits above 250,000. But the more you get towards the JP Morgans of the world, probably the lower the odds are that they would ever let depositors lose money, I would guess. Although they may show that across the system, they're not going to let depositors lose money.
And they may. And now it just becomes a question of like consumer choice in that thing, because there's a really pithy quote going around the internet about, what is it about? Basically like banks are just speculative investment funds. And in a sense, that's true. But there's also this concept that like banks only do two things. They both get money and they give money. So they'll take your deposits and they'll give you a loan. And inside that is a business. And each business has to make choices about how to make profit, because that's what businesses do. They earn profits to eke out their economic survival. And inherently, whenever you have somebody trying to figure out how to make a profit, once in a while, somebody's going to screw something up. And the problem with banks is if you screw something up just in your neighborhood and we have a little bit of a headache, that's okay. But if you nearly bring down trade for the world, that's not okay. And that's the hard part about democracies and capitalism. How do you solve for this?
You had mentioned credit unions and cash value and insurance policies before. Can you just talk a little bit about more about what the level of protection is there?
This is also, it's good to say, and this goes all the way back to the creation of the Fed. It's one part about compliance, but it's also about confidence in the system. And so let's pick on like insurance companies. Insurance companies go belly up too, just part of the business. And so each state has a state guarantee fund for their insurance and their cash value policies. And much like FDIC, much like SIPC, what they really want to see is somebody else step in. So if a life insurance provider goes belly up, they're really looking for, okay, is there somebody else who can honor these claims or honor these policies or restructure these policies so that the consumers don't get hosed on these things? And each state has their own version of this program. So like if you have $1 million in cash value in a life insurance policy, you should know both where that money is, and then you should know what's your state guarantee fund in case that company blows itself up for some reason. The same goes for credit unions. The NCUA insurances look a lot like FDIC, and certainly the NCUA is going to step in and try to facilitate a takeover of your deposits to maintain service in the event of a failure. But these things happen too. Credit unions get screwed up and then they get assumed into other ones. So if you have a credit union deposit, just like FDIC, you want to vet what your stuff is and know how you're protected, just so you know, just to be safe, just so you know, it's the responsible thing to do.
Since I know you work with clients a lot, I'm just wondering what the last week has looked like. I mean, have there been people calling worried about the security of their deposits or worried about a market meltdown, or have you seen any kind of panic like that, or has it been pretty just business as usual?
So security of deposits, and so aside from getting texts from my grandmother, worried about what to do, and got her calmed down, and she doesn't have anything to worry about here. But like, there's more reality to this, and maybe this goes into the last part about what does it mean for the rest of the markets in the world, is with clients, it was just checking in with some business owner clients and other people with like higher net worth with relationships at multiple places going, okay, is there anywhere where over the $250,000 limit, especially with your regional banks exposure? Like we really focused with clients on talking about not so much the JP Morgan or the Bank of America or the Citi balances, but let's relook at that Capital One savings account where you're getting that higher yield you told us about. Let's look at the local bank account where your business has the operating account and you have the credit line because the local bank gave you better terms than JP Morgan could have given you or whatever. And reviewing those for the deposit type, the institution itself, and then also the ownership classification. So if you did have an uninsured or potentially uninsured deposit somewhere, we tried to review that with as many people as possible in the last, week and change. Now, beyond that, the other thing was we had to be mindful of like private equity and other companies who might have banked with the SVBs or some of the other entities out there. So if you were having capital calls, or if you have a vendor that you use for your company and they happen to bank there, like you probably didn't want to send them a check by accident in case all of a sudden that money wasn't going to be good. So great, you have some vendor who banks there, you're going to pay your bill for it, but then that vendor all of a sudden can't access the capital. And so we had to review some of that stuff too, whether it was for private investments or for other business entity types, and just say, pause on everything, have conversations with anybody who might be linked to these or other smaller regional banks, and just make sure you account for all the money, where it's coming from, where it's going, because had the Fed not stepped in and done what they accomplished over the weekend, it was a really rough couple of days and then a rough weekend of conversations, just making sure everybody was okay. Good news so far, no problems, but a little bit of drama.
Yeah. And just from my perspective, in terms of hearing from clients, I think it's a little bit more about seeing the decline in the account values, more than, I'm concerned about my bank's going to fail. So, I think obviously the decline in the market as a result of what happened, it's important to be in touch with clients, be educating clients. I think helping clients sort of think long-term and think about their goals and not get too caught up in, what's happened over the past 2 weeks. But you also can't ignore when you have an event like this, just being on top of it, at least with us in the portfolios we run, looking at our financial exposure and being able to, help clients make it through to the backside. Because ultimately we will get through this. There could be more pain ahead. There could be more bank failures, hopefully not. But, I think this is where financial advisors like you, Matt, and like us, when we're managing actual money, are worth the fees that people pay, because we help people from making bad short-term decisions, and staying focused on their long-term goals. But, there are times in the market where people get nervous and scared, and that's just human behavior. And this is, I think, one of those times.
And with banks in particular, the shock and the PTSD we all carry with us from the financial crisis is we have this memory of what happens when the banking system gets shocked. So I'm talking about like what we just had to do to just check on day-to-day operations and business with clients. But the reality is like, okay, so a bunch of banks have problems. Well, back to the banks, give loans and get deposits. So all of a sudden they can't get loans. And in the financial crisis, it was in large part about like, well, you don't make mortgages, and then a bunch of home builders don't work, and then a bunch of plumbers don't get to do stuff. And those ripple effects, whenever there's a crunch, whenever something breaks in the banking sector, those ripple effects could be really, really far reaching. And so having a market event like this where the markets go haywire over the last, week or so, it's really important to talk to clients because this might get worse before it gets better. The Fed's been hiking, something broke, and now we have to figure out, well, how much does this mean?
So I think in summary, we've talked about FDIC insurance, we've talked about SIPC insurance, we've talked about some of the intricacies of some of these other custodians and brokerage firms that are sort of a blend of the two. I think, Matt, to your point, you got to go dig around the website, wherever your cash and liquid assets are, to see what type of insurance coverage is there. We'll put a link to the FDIC document in the show notes, and we may even be able to put a graph up if I see that document. I'll see what's in there. And then, if you have questions, ask your financial advisor to help you navigate this stuff. It can be confusing. You do have to get in the weeds on some of it, but hopefully this conversation today with Jack, Matt, and myself was helpful in anyone that's watching this sort of think about this stuff. So we appreciate you guys watching, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at @JJCarbino, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.